Real estate investment can be a great way to accumulate wealth and achieve financial freedom. However, novice investors often make costly mistakes that result in lost profits, failed projects, and financial hardship. In this article, we'll discuss the top 10 common real estate investment mistakes that novice investors make and offer advice on how to avoid them. 1. Investing without a plan. One of the biggest mistakes that novice investors make is jumping into real estate investment without any goals in mind. Without a clear plan, it will be difficult to make informed decisions and stick to a strategy. The consequences of not having a plan are wasted time, money, and effort. Advice: before investing, investors should create a roadmap outlining their goals, investment strategy, and financial projections. This plan will guide their decisions, ensure that they stay on track, and help them achieve success. 2. Rushing into a deal. Another common mistake that novice investors make is rushing into a deal without conducting proper due diligence. By skipping crucial steps like conducting market research, inspecting properties, and analyzing financials, investors can suffer significant losses. Advice: before investing in any property, investors should take their time to conduct thorough research and analysis. This includes researching market trends, property values, and conducting in-person inspections to assess the condition of the property. 3. Failing to account for expenses. Many novice investors underestimate the expenses involved in real estate investment. This can include costs associated with renovations, repairs, property management, taxes, and financing. Failing to account for these expenses can lead to overspending and financial ruin. Advice: investors should create a detailed budget, accounting for all expenses. They must also factor in potential risk factors such as vacancy rates, unexpected repairs, and fluctuations in interest rates. 4. Over-leveraging. Investors may sometimes take on too much debt when financing their investments. By over-relying on borrowed money, investors may be exposing themselves to substantial financial risk. Advice: investors should remain conservative with their borrowing and ensure they have enough cash reserves to fund unexpected expenses or setbacks. 5. Ignoring location. One of the most critical factors that can determine the success of a real estate investment is location. Ignoring the importance of location can lead to investing in properties that either fail to attract tenants or appreciate in value. Advice: investors should conduct thorough research on the area where they are investing in, seeking to understand market trends, demographics, and development projects. 6. Lack of diversification. Failing to diversify their investment portfolio is one of the most common mistakes that novice investors make. By putting all their assets into a single property, they could potentially lose all their money with one bad investment. Advice: investors should spread their investments across multiple properties, diversifying their portfolio by investing in various asset classes and property types in different markets. 7. Not having an exit strategy. Failing to have an exit strategy in place can leave investors trapped in a bad investment. Without an exit plan, investors may become bogged down in a project that is no longer profitable. Advice: investors should develop an exit strategy that includes considering various scenarios such as market fluctuations, interest rate changes, and property value, and determine the best time to exit the investment. 8. Poor property management. Poor property management can lead to plummeting occupancy rates and ultimately, a decline in property value. Neglecting tenants or ignoring maintenance issues can lead to disastrous outcomes for investors. Advice: investors should take an active role in managing their property, or hire a professional property management team. A good management team can ensure that the property is well maintained, tenants are happy, and the investment remains profitable. 9. Not knowing their limits. Understanding their financial and personal limits is vital for investors. Ignoring these limitations can lead to overextension or burnout. Advice: investors should evaluate their financial and personal limits before committing to a project. Determine their capacity to take risks, and remain true to their investment goals and objectives. 10. Giving into emotional attachments. Investors may sometimes become emotionally attached to a property, leading them to make poor financial decisions based on personal attachments rather than financial considerations. Advice: investors should avoid becoming emotionally attached to a property and evaluate all decision-making based solely on data surrounding financial returns. In conclusion, novice real estate investors must conduct thorough research and have a plan in place before investing in properties. They must also factor in potential expenses, risks, and develop an exit strategy. By avoiding these common real estate investment mistakes, investors can improve their investment performance and achieve financial success. Investment performance